Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
All right, everyone, welcome. Today, we are going to tackle a concept that is right at the heart of Canadian tax law, non-arm's length transactions. Now, I know it sounds super technical, right? But trust me, this is an area where even simple, totally well-intentioned deals, between family members or related companies can lead to some surprisingly painful and really costly tax consequences. The rules here are definitely complex, but really understanding them is your absolute best defense. So, let's dive in.
Okay, so here's our game plan for today. First, we're going to start with the big picture, the core problem the government is trying to solve with all these rules. Then, we'll break down the 3 key rules you'll find in the Income Tax Act. After that, we'll apply these rules to a real-world case study so you can see just how punitive, and I mean punitive, they can be. And then, most importantly, we'll wrap up with the proactive steps you, as future professionals, can take to avoid this whole double taxation mess.
All right, let's start at the beginning with the fundamentals. Before we get bogged down in all the dense legal stuff, we really need to get our heads around the core issue. And that is, why does the Canada Revenue Agency, the CRA, care so much about who you're doing business with? What's the big deal?
So first things first, what exactly is a non-arm's length transaction? Well, put simply, it's just a deal between related parties. Think about it like this: a parent selling a piece of property to their child, or maybe 2 corporations that are both controlled by the same shareholder. The key assumption here, the whole reason for the special rules, is that these parties probably aren't bargaining like strangers in a competitive market, right? They might have other motives besides just getting the absolute best price. And this brings up a really fundamental question. Why do these special rules even exist? I mean, why can't 2 related companies just decide to transfer an asset between themselves for, say, $1 if they both agree to it? What's the problem? Well, the answer is actually pretty simple. It's all about protecting the tax base. See, the CRA knows that when you're in control of both sides of a deal, there's this massive incentive to play with the price to lower your overall tax bill. For instance, you could try to shift profits from a high-tax company to a low-tax one just by selling an asset at an artificially low price. And these rules, they're designed to stop that, plain and simple. Okay, so now that we've got the why down, let's get into the how. The Income Tax Act lays out 3 very specific rules that govern these kinds of transactions. Let's break them down one by one.
So these are the 3 main situations the rules are targeting: selling something for less than it's worth, that's fair market value or FMV, selling it for more than it's worth, or just giving a piece of property away as a gift. And as you're about to see, those first 2 scenarios have outcomes that are, well, they're intentionally designed to be punitive.
All right, let's kick it off with rule number 1, selling below fair market value. The absolute most critical thing you need to get here is how one-sided this adjustment is. Essentially, the CRA says to the seller, look, we don't really care what you actually got paid. For tax purposes, we're going to deem that you received the full fair market value. But, and this is where it really stings, they make absolutely no matching adjustment for the buyer. So the buyer's cost for their tax records stays at that artificially low price they actually paid. Ouch. Okay, now for rule number 2, which is just the flip side of the coin, selling for more than fair market value. This time, that painful punitive adjustment just shifts over to the other person in the deal. The seller, they get taxed on the full high price they actually received. No break there. But the CRA turns to the buyer and says, whoa, sorry, you overpaid. For tax purposes, your cost is capped at the fair market value, not that higher price you paid. So again, you see this pattern. It's a totally one-sided adjustment designed to penalize someone.
And finally, we have rule number 3, which covers gifts. Now, this one is a bit different. It's not designed to be punitive. It's more of a neutral adjustment just to make sure the tax system reflects what really happened, economically speaking. So when you give an asset as a gift, the law says you're deemed to have sold it at its fair market value. This can trigger a capital gain, just as if you'd actually sold it for cash. And on the other side, the person receiving the gift is deemed to have bought it at that same fair market value. This sets up their cost base for the future. And here's a key detail to remember. This rule for gifts applies to everyone, whether you're related to the person or not. It's universal.
Okay, so theory is one thing, but let's actually apply these rules to a case study to see how they work in the real world. This is where you're going to see exactly how these one-sided adjustments can create a tax result that is, frankly, just brutal. So here's our scenario. We've got 2 corporations. Let's call them Corporation X and Corporation Y. They're sister corporations, which just means they're controlled by the same group of shareholders.
This is a classic non-arm's length relationship. Corporation X is the manufacturer, they make the stuff, and Corporation Y is the wholesaler, they sell it.
Okay, first number you need to know, the cost. It cost Corporation X exactly $10,000 to produce this batch of inventory. That's our baseline. All right, second key number, the fair market value, or FMV. If Corporation X had sold these same goods to some random neutral third party, they would have gotten $13,000 for them. And you can bet this is the number the CRA is going to be looking at. But of course, that is not what happened. Instead, Corporation X sold the inventory to its sister company, Corporation Y, for exactly what it cost to make, $10,000. What was their goal here? Well, they were trying to shift the entire profit over to Corporation Y. Then Corporation Y turns around and sells the goods to a real customer for $18,000. This whole transaction is a textbook example that immediately triggers rule number 1, selling below fair market value. Okay, so now let's see what this looks like when it's time to file taxes. For Corporation X, the seller, the CRA is just going to completely ignore that $10,000 sales price. Instead, they are deemed to have sold it at the fair market value of $13,000. So $13,000 in sales minus their $10,000 cost, that results in $3,000 of taxable income for Corporation X. Now, what about Corporation Y, the buyer? Remember what we said about this being one-sided? Their cost basis stays at the $10,000 they actually paid. So when they sell the goods for $18,000, they've got to report $8,000 of taxable income. That's the $18,000 sales price minus their $10,000 cost. And here is where you see the punitive outcome. Let's just step back and look at the actual economics of this whole deal. The inventory cost $10,000 to make. It was ultimately sold for $18,000. So the real, actual economic profit for the whole corporate group was $8,000. Simple math, right? But what's the total taxable income being reported? You've got the $3,000 from Corporation X plus the $8,000 from Corporation Y for a combined total of $11,000. The absolute crucial takeaway here is this. $3,000 of that income just got taxed twice. It was taxed first in Corporation X's hands when the CRA deemed the sale price, and then it was taxed again as part of Corporation Y's profit. This is what we call phantom income. It's profit that doesn't actually exist in the real world, but it gets created purely for tax purposes. It is double taxation, plain and simple. Okay, so that case study is a pretty stark example of what not to do, right? So, as future tax professionals, how do you stop this from happening to your clients? Well, the good news is there's actually a pretty straightforward way to protect everyone from this kind of disaster. The solution is found in a simple but incredibly powerful contractual tool. It's called a price adjustment clause. What this clause does is it basically acknowledges that figuring out fair market value isn't always an exact science. People can make honest mistakes. And this clause gives you a mechanism to go back and correct those mistakes after the fact. So here is your playbook. For any significant transaction between related parties, you absolutely need a written agreement. In that agreement, you need to clearly state that both parties intend to do the deal at fair market value. And then you include the magic bullet, that price adjustment clause. This clause basically says, hey, if the CRA comes along later and challenges our valuation, we both agree to go back and change the price to whatever number the CRA says it should be. What this does is it gives the CRA the green light to make a two-sided adjustment, fixing the books for both the buyer and the seller. And just like that, the double tax problem is completely eliminated. It is such a simple, proactive step, and it can literally save a fortune. And you should also keep in mind, this isn't just some quirky Canadian issue. These exact same principles, they are the bedrock of international transfer pricing rules. Countries all over the world use these concepts to stop huge multinational corporations from shifting their profits to low-tax countries. It's the exact same problem we've been talking about, just on a global scale. So I'll leave you all with a question to think about. Are these punitive rules a necessary evil to make sure our tax system is fair? Or are they really just an unfair trap for people who are maybe a little unwary or just make an honest mistake? It's a really central tension in tax policy, and I guarantee it's something you'll bump up against again and again throughout your careers. Thanks for your attention, everyone.